Hi, this is Hadi Shafiq from SmartFX. How are you guys doing? Welcome to my webinar. Today we are going to be talking about risk management and leverage, about the Forex market, about online trading. So hope you guys are excited. And let's start. Before we begin, this is a reminder, follow us on our social media platforms, Facebook, Twitter, Instagram, LinkedIn, YouTube, to stay updated, to get the daily updates and what is going on in the market. So make sure you follow us, like, you'll find the best content over there. And these webinars will also be posted on our YouTube and maybe our Instagram later on. And that's my personal number over there. You can call me, WhatsApp me, contact me anytime. Feel free. I will always gladly help you guys, whatever the time. Leverage in trading, how does it work? So basically, leverage is when you have a small capital and you want to invest in the market, whether that be Forex, whether that be stocks, anything in general. In finance, leverage is putting your money down and getting an excess of equity to trade with or to invest with. So whether that be like Forex, index, stocks, commodities, treasuries, ETFs, which translate to exchange traded funds. Leverage is, for example, when you put like $5,000, $10,000 and your facilitator, your broker, your service provider allows you to trade in excess of that. That is simply leverage. We'll go in more details about it. Move on to the next page. So, for example, I'll give you a basic example. You have $10,000 with you, and you want to invest in the market. You open an account, you deposit that money. Now, you want to trade in excess of that. Normally, brokers do allow 20x, 50x, 100x of your investment. So what that basically means is when you have a $10,000 account, you can trade 20x, 20 times more than your actual investment, which translates into $200,000, or 50x, which translates into $500,000. And if it's 100x, that's $1 million. So how does that work? It's not that when you place a trade and now you have $1 million, boom, and now you can cash that out. No, that's not how it works. The way it works is when you place that trade, let's say for $100,000 extra, you have borrowed the rest of the amount from your broker. And on the basis of that $100,000, you will get the returns on your account. So let's say you bought $100,000 worth of gold and the market goes up 1%, and your initial investment is $10,000. What will happen is that basically the return you generate on the $100,000 will affect your account, it will reflect on your account. So if the market goes up 1%, you're going to gain $1,000. And if it goes down 1%, you're going to lose $1,000. So how does that reflect on your initial investment? Because remember, you put $10,000 down. So when you put $10,000 down and you gain $1,000, that's 10% ROI on your investment. And if it goes down, there's 10% negative drawdown on your investment. It's as simple as that. Leverage is simply when an investor borrows money from his facilitator or service provider to trade more, to invest more, to basically do more so that he can earn more. This is one of the examples that you can read, that 10 to 1. Yeah, when you see these digits like 10 to 1, 50 to 1, it is showing the amount of leverage they offer you. So yes, if there's a 10 to 1 leverage, if you take this exact example, a 10 to 1 leverage ratio, and you want to enter a trade, and let's say you have 1,000 euros. So with 1,000 euros, you can trade up to 10,000 euros. And the margin in this scenario is the 1,000 euros. The 1,000 euros would be considered the margin, because that is the money required to open the trade. And when over here it's written as the overall cost, cost translates not in an actual cost or a fee. It is simply the margin, the money required to open the trade. So if you have 1 to 10x, 10 to 1x leverage allowed on your trading platform, and you have $1,000 in your account, You can trade up to $10,000. Until you have that thousand, you will have the capability or the access to trade 10x. Once it goes below that or you lose it somehow, then you won't have the access to trade exactly 10,000 euros. It'll be lower. 10x whatever the equity you have in the account. In this example, obviously, when people are new to the market, you need to take it slow, especially if it's leveraged, because leveraged products are considered risky in the market. They're called high risk assets, high risk portfolios. So what you do is initially you start slow, whether you have 20, 30, 50x leverage allotted to you, but no, you go slow. You try to trade with your investment. And let's say, for example, you have $10,000, then you start trading 20,000 euros or 30,000 euros, 25,000 euros. This is a very good way to start your trading journey, because if you jump in it and you try to, go aggressive in it, you might lose your capital, and that is not good. Obviously, you must always remember to protect your capital. So initially you should start slowly. As it says, a buy and hold approach will be more suitable if you're long term based. So you should try out short term trading with lower leverage, even long term when you're holding a couple of weeks and months, initial period of your time until you have a good grasp of the market. Because before that, you should not actually jump into it. So take it easy, guys. Don't attack the market like directly. Take it step by step. Take your time, learn. Market is gonna go nowhere. It's there forever. So take it easy. This is an actual example in stocks. So if you have, let's say, a 5-to-1 leverage, okay, and you have a $10,000 account and you want to purchase some stocks. So it means in that scenario, let's say if you want to buy Apple, you can get up to $50,000 worth of Apple shares with the $10,000. So what happens is that in certain scenarios, there is a thing called maintenance margin, that there's a certain amount of maintaining you have to do. And if it falls below that, it will send signals and it will alert you that your maintenance margin is falling. So in this scenario, when you're maxed out on your leverage, 50% would be the maintenance margin. It means you have to keep your equity above $5,000. Otherwise, it becomes too risky for your account. So in that scenario, either you lower your position or you add more funds to handle the situation. But usually you should never max out on your leverage. That just means you're overextending your account, and that is not a good thing. You should always keep this in mind, even if you have multiple trades open or a single trade open, that there is a certain amount of leverage which should always be in the account, certain amount of margin. You should be free in your account. You should not be overexposed. So in this scenario, if you have $10,000 and you traded $50,000 worth of stocks, because each asset has different type of stocks, different type of leverage, I'm sorry. Stocks have a different leverage ratio. Forex has a different leverage ratio. The spot market is different. The future market is different. So you should calculate, you should know these by heart, that what level of leverage you're taking. And you should not forget that there is a maintenance margin. After opening all these trades, there should be some free margin in your account left. So you can, breathe and not stress about it. So leverage products represent speculative assets that offer traders larger exposure without putting the full value of investment. You can read here to understand, to get a better grasp. It'll be the things I've just told you. So most leverage trading strategies involve strict risk management. You should, number one, people think it's about like signals and knowing when to enter. Okay, that is a good part of it. But risk management is the key to success in trading and the key of not losing a lot of money. What is risk management? Proportionately checking how much money you can actually invest, first of all. How much is it's not going to bother you, even if there's some drawdown on it. For some people, it's $1,000. For some people, it's $10,000. For some people, it's $1,000,000. You should know how much money you can invest. The first thing. Second thing, the type of strategy you use, whether you're comfortable with high risk, medium risk, low risk, what is your own appetite for risk? You should measure that, you should know that. And after that, when you get into a strategy, you should draft it according to your own psychology and start trading. So if you are, even if you have a lot of money and you don't like taking risk, that's when you avoid risk. You put in the money, use less leverage, as we were discussing before, not 10, 20x, not 50x, just using 2x, 1x, 3x your investment. And then you take it slow from there. But if let's say you have $10,000 and your appetite of risk is high and you are not going to be stressed out about the investment or anything, even if you lose a big part of it, you're not going to be sad. That is a very good understanding of yourself, and you can allow yourself to use higher leverage like 10x, 20x, 30x. So you should know yourself when you get into this. And your leverage positions can be vulnerable to some added risks, as it's written over there. The margin calls. So margin call is basically when you fall below a certain level of margin, which is already trading. So let's say, for example, you have $10,000 and the margin which you're utilizing is $8,000. When the equity will fall below $8,000, there will be an alert to you to maintain the margin. Remember the maintenance margin? So what happens in that scenario is, again, you have to either fund the account or you have to lower the positions. But if there's a sudden movement and you have not thought it through and your equity falls to a certain level, there can be auto liquidations, which is the worst thing which can happen to an account. So you should keep that in mind, which is possible. So suddenly if the market moves, makes a big move and you have a big position open, your account can get liquidated. It is a possibility and you should take care of that. And when you plan on getting into the market, let's say your strategy is short-term based, you should always work with certain parameters, which are like stop losses, trailing stops, take profits. Because usually when people get into short-term trading, they go with higher leverage, but for a small time. They'll be in the market for a few minutes to a couple of hours maximum, and they'll get out. They're not going to hold that position overnight. They're not going to hold it for a long time because that's how their strategy is. And some people do make a lot of money from that. And leverage products are derivatives of your underlying assets. When you are trading leverage products, you are not actually owning them. You're simply trading the price of that asset. And there's different type of leverage for like retail traders, professional traders. Both use it to try to make more money. In this day and age, it is very easy for a retail trader to get into the market. Previously, it was more tricky. So this is the thing which we should, we should take advantage of. But you need to grasp the risk of the market. You need to grasp what you're getting into. So you truly understand when you're trading with your hard-earned money, you're more responsible with it. Leverage for indices. So indices or index, it represents like a whole country in a sense. For example, if you take the S&P 500, it's 500 of the biggest Fortune 500 companies in America, which are listed in the American stock market. They get compiled into one single stock, you can say, and an index is formed. These are considered more of a secure investment, safer investments, because they are volatile, but they do not have big, massive drawdowns or big, massive moves upwards. They focus more on longevity, that they will be going up for a long period of time consistently. Like if you see the past 50, 70-year history of Dow Jones or 100 years, Dow Jones is another index, American index. It has been given like 10, 12% ROI yearly on an average. There are some years where it goes up 20%, 15%. Some years it goes down 5, 10%. But on an average, consistently throughout time, it has been giving a very good return. And the most riskiest of all is actually UT 100, called the NASDAQ. Why? Because it's dominated, like, it's focused on tech stocks. And tech stocks in their nature are volatile. But that is the one, if you see in the previous years, like in the past 5 to 8 years, it has gone up nearly 400%. So $1,000 investment in that would be worth $5,000 to $4,000 today. So you guys should think about it. With risk comes rewards, but you should be educated enough to understand what risk you're taking. In UK, we have the FTSE 100, 100 of the biggest British companies, and the same thing goes on. And these things have low margin rates, so therefore they have high leverage ratios, 20x, even 15x, 30x, you can get it on them. And again, you have to be careful. Even if they are a safer investment product, you should still be careful, because whenever there's leverage involved, it can change the atmosphere basically dynamically. And leverage ratio, as it says, there are more than 9,000 international shares where their CFD trading is allowed, leverage trading is allowed, and it starts from 5-to-1 ratio, or it's called a 20% margin ratio also. And when you open a position with the 13,600 units, these are considered the lower tiers. After that, when you open a certain big position, the margins change. When you open a very big position, the margin level goes lower. You need to have more capital in the account, because that offers lower risk, because the service provider and even the trader should not take a lot of risk on either ends. So, but this is not something like a retail trader will be worried about. It's more of a professional trader will be worried about it, because people do trade with a big volume, a massive volume that a normal trader cannot even, like, fathom. Where someone is trading with $1,000 or $10,000, there will be one giant trading with $1 billion or $100 million. So they both are on two different places, but at the end, they both are availing the same platform, same facility, and they both are in pursuit of same thing, which is making money. There is leverage in cryptocurrencies as well. Usually cryptocurrencies have a lower leverage because it's such a volatile class, either 2x or 5x, but there are futures in cryptocurrencies which offer a much higher leverage. Personally, I would not recommend that. Even if you want to get into cryptocurrencies, it's better to buy and hold. That's a simpler approach. But when you start using risk, like leverage, something as risky as leverage in cryptocurrencies, that is like a recipe for disaster. In that terms, Forex is much, much, much better. Because see, Forex is not as volatile as cryptocurrencies, where Forex will move, any Forex currency will move 2% or 3%, that too on a very good day. Cryptocurrencies will be moving 15, 20, 30% or 10xing. And cryptocurrencies till now are a little bit of a vague field, but Forex has, stood the test of time. People know what it is. You can physically cash it out. So whenever you use any strategy, you should be focusing on something we call like stop losses, whether that be Forex, crypto, or anything at all. If you are into the short-term approach or mid-term approach, you should focus on stop losses, trailing stops, hedging your positions. That way you stay safe. So what is a stop loss? At a certain level, if your position has a drawdown, which is beyond your expectation or beyond your limits, the position can cut automatically without having any extra risks. So let's say you have a position and you don't want to lose more than $300 on it. You just set the stop loss of $300 and leave it. So whether you're on the platform or not on the platform, that position will cut by itself. Same thing, opposite works. We have a thing called take profit. So let's say you say, I don't want to lose more than $300, and my focus is to make $600. So in that, we would call this a risk to reward ratio of 2-to-1. So you're risking 1 to make 2. So what happens in this scenario is that, let's say, for example, your TP hit, whether you're at the platform or not, and that position comes, that price comes. So let's say you put the stop loss at 1810 and you put take profit at 1830, and 1830 for gold specifically, it comes before 1810. What will happen in the scenario is the TP will hit and the profit will get secured. So you don't need to be physically present at the platform. These are some of the tools which you can avail to make money in this market, in this facility, in this trading platform, which we offer. This is a leverage ratio formula. So leverage equals asset divided by equity. So let's say again, there's a $10,000 account and the position is worth $100,000. So what is the leverage you're using? That's 10x. So you take the asset divided by the equity. So $100,000 divided by $10,000 equals 10. That's the amount of leverage you're taking. Let's flip the equation. If let's say you have $10,000 and you have $1 million worth of position, what's the leverage in that? Again, $1 million divided by $10,000, and the answer is 100. There will be 100x leverage you're taking. It's a very simple formula in trading. This is the way also of calculating the leverage ratio, how to determine the position size. Asset equals equity and leverage. That's a complete thing. So there are a lot of traders. What they do is they spread out their positions through multiple sectors, multiple asset classes. They have a little bit of gold, a little bit of forex. They put a little bit of stocks and a little bit of futures, and it's spread out across. But if you should make sure when you are spreading out or diversifying your portfolio, you do not over leverage, because in that also, for example, you take 3x leverage in gold, 3x leverage in forex, 3x leverage in stocks. Like that, you're building up leverage, and it can be, there's a lot of good leverage, but there can be bad leverage as well. So what happens in that scenario is that your account, it will not be able to handle any massive fluctuation on either ends, because once the market starts becoming volatile, it'll hit your account and you will see the signals of margin calls, even though if it has not moved a lot in certain sectors, but overall when it's impacting your account, it's going to be showing that you need to add up more money or top up more money. So you should be making sure when you're diversifying your trades amongst different sectors, different assets, you do not accumulate a lot of leverage. In that scenario also, you have to be very careful and take it slowly. So what you can do is simply take, initially, when you're new and you want to learn more about the market, take smaller positions throughout. First, do one thing, pick an instrument which you like, one or two instruments, trade them on a regular basis. And after that, you can start getting into different assets, different classes, different instruments. Like that, what will happen is your understanding and your management skills will build up. And then you can dive into bigger trades, more riskier trades, which you can handle. So that's as simple as that. And you should not complicate it. Keep it simple always. There's a difference of leverages also when it comes to a retail trader and a professional trader. But there's a reason for that, because usually when a retail trader comes, the broker, we tend to give them a lower leverage. Why? Because he's a new trader. And when there's a professional trader involved, now the thing is, a professional trader, he already knows the market, he understands what's good for him, what's bad for him. So he can have access to higher leverage rates. Why? Because he understands the market. And it's better that we protect our clients even from their own mistakes or their own ignorance. That's why retail traders have an access to a lower leverage set, but a professional trader can have access to a larger leverage. So it's better that way. Both of them stay protected, and we don't want basically our clients to lose money quickly. We want them to make money, grow money. That's why we have to think for them even before them. As we discussed stop loss previously, by implementing a stop loss order, you can limit your losses. So that is a very important. You should highlight this, read this again and again. Why? Because more important than making money is saving money, not losing money. That is in the crucial part of this game, because there's a lot of people, they get excited, they come, they're new, and they start, acting like it's a video game. And then what happens, they occur losses, and then they become, disheartened by it, and they don't even want to look at it. So when you initially understand, okay, you should use stop losses, control the losses, you will automatically start becoming more responsible, more disciplined. You'll automatically start becoming a better trader. If just by understanding that to use stop losses, to not incur big losses, to manage these positions. So that way, it's a more intelligent thing to do, as simple as that. But do not keep some crazy situations, like, you keep them very squeezed, very near to your targets, and you take big positions. That's not how it works. Even stop losses need to have some sort of a strategy behind them, and some sort of a distance between the current market price and the actual stop loss. So you should think it through. So I hope this webinar was educating enough for you, and that you liked it, you guys enjoyed it. Again, please do not forget to follow us over here. All of our social medias are there. Smart FX Brokers. So I'm Hadi Shafiq from Smart FX. You can contact me from any night and day, anytime. I'm looking forward to our next webinar together. Bye.